Hi there, traders. This is Brad Gilbert with the FX Market Insight for Thursday, the 11th of March. All right, let's just have a look where these markets are. The US equity markets, well, the Dow Jones was up, but the market raw nerve there, the Nasdaq, just slightly down. Now, the whole structure of the market really came in defined here into the US CPI numbers. They came out as expected, and if anything, was a little bit subdued or a little bit pissed off that they actually came out as expected. What we saw is the treasury yields just drift off a touch, right? So they're just a touch lower from where they were yesterday. Have a look across the board there. Now, with that slightly lower yield, takes the pressure or the strength of the US dollar out of the equation. The CPI numbers doesn't do a lot for what the Federal Reserve were talking about, maximum employment. They're going to let inflation go. Well, it really hasn't kicked into gear. So I think the treasury yields or bond traders were sort of a little bit not confused, but a bit lackluster data. Sort of, they just probably took a bit of cash off the table. So we had a situation where the equity markets, because the yields have just drifted lower, that pushed the dollar down a bit, pushed the dollar block up only a little bit. Equity markets were a little bit like scratching their head to see what was going on there. And when you come back and look at the instruments, you can see them sort of, or the technicals, I should say, just drifting sideways through some of these levels. Actually, let me just blow up that euro because this is the one I'm sort of really focusing on. You look at the euro, just sort of drifting through. We've got this resistance level around 119.20, just blowing sideways. Now, I still don't think the US dollar move is over yet. Trends don't just go up and down in direct lines. This is like a bit of a corrective process. We now are waiting to see where the next direction comes from. Euro, to me, is probably the best currency pair to be trading. Right now, you have to say, well, I'm expecting the dollar to go back down. So I need things to stay as they are. We've had the CPI numbers out, US CPI. Bond yields are a little bit lower. Takes a little bit of that strength out of the US dollar. Now what we have to focus on or refocus on is what could impact the next move. And of course, we've got the ECB meeting today, right? So we'll find out more about what the ECB are doing. No change in rates expected. So it's going to be a little bit of a convoluted situation where you got statement, you got press conferences, like lots of dynamic things. After it's all settled down, are we going to have euro weakness or strength? Well, I've got to say, I'm not confident in it, as in the data. So you square up that position. If you did manage to get short euro on that rally, well, that position is now stale as we wait for the ECB, right? So I'm sort of waiting for the ECB, if anything, waiting for it to break back down. And it's an easier trade to be looking for a break back down through the trend line than sitting short and hoping that it doesn't go up, right? Because you know what, we could see a short squeeze very easily up towards, say, 119.75, 120 the figure. And when those treasuries, US treasuries kick into gear, that's where direction's coming from. If they start to rally again, which I expect, then the dollar will rally and euro will fall. But it's going to come down to the ECB next. So make sure you tune in for this one because the next major move will come from the ECB. That's what the highlight is. And at the moment, right, if you look at euro, like if you were static, and you didn't know about fundamentals, you get short here. Now you're nursing a loss and sort of looking down the barrel of a loss. Where if you are a dynamic trader, you know that the CPI numbers were going to impact. You get out of the position or close that pending order, reassess the market. Now we know the ECB is coming up. We've got a situation here where it could very well easily squeeze up 50, 60 points, right? You don't want to be short through that process. And it's very hard to get long here as well. So to me, you just avoid it. And I'm looking to get short after the ECB announcement, after everything's out of the market. It's either going to be a euro negative situation or I can't see the US treasuries going down that far. So they should stabilize and probably come back a bit and we see the euro lower. That's my overall view and opinion. It may vary from yours and of course may not turn out that way. But that's where my focus has come from understanding what's happening in the US treasury yields, understanding what's happening with the data, US and European, and on all fair value, that's the sort of best trade I can see at the moment. And, that's where you're going to be looking at. So Actually, there's one other thing I wanted to just highlight. So let me just change screens. Make sure you're keeping an eye on the, excuse me, the yen crosses, right? They're all sitting nicely above the cloud at the moment. So you know what? All we need is one big event. Particularly euro yen's going to be in play with the ECB. You break back down through the cloud here, or a yen move should see all these things collapse. Just keep an eye on them. This is something you should just glance across at each day and see if there's any structure to what's going on across the yen crosses, because these puppies work the same. Unlike the majors, where the US is the base and sometimes the terms currency against some pairs, this is the yen quoted the same way against everything. So you can see what the yen's doing very clearly. And there's diamonds in the rough here. All right, guys, that's it from me. Keep an eye on the ECB. That's got to be a major focus going up towards the next 24 hours. So when you are looking at the major pairs, let me just change screens. Okay, you're looking at to me, the euro, the ECB, obviously, and also keeping a close eye on those treasury yields or treasury prices. You can work out what the impact is going to be. Higher yield, stronger dollar, right? And vice versa. Cheers, guys. Have a good one.